this in this endeavor, we have tried to dig deep into it to, firstly identify all the small active management aspects that go into a portfolio. Because at the end of the day, portfolio returns or XIRR returns is a culmination of all the good and bad things that went into a portfolio. It may be related to, done transactions, maybe redeeming where we shouldn't have, or maybe catching on to a very good bull run, all those sorts of things. So the entire storytelling gets hidden behind the XIRR number. So this is what we try to unravel through this tool. So the first aspect, as Ronak said, is the portfolio NAV concept. So this is, I consider, this is the backbone of our entire tool, because so to give you an analogy, mutual funds today, they have their NAV published all across. Mutual funds, we can compare mutual funds against benchmarks, against other mutual funds. We can create a lot of, do some analysis on top of it. We can create these metrics. We can even do ratings on these mutual funds. So the idea was if all of this can be done for a mutual fund, because it has a NAV published on a daily basis. Why can't we do that for any other portfolio? So in a sense, every investment portfolio can be considered as a mutual fund, in which the portfolio is invested into a certain amount of underlyings, and money comes in and goes out of that investment pool, or in our case, the portfolio value. So mutual funds were able to discount all that and present a very very simple representation of how their portfolio has grown just by being in the market. So this is what we try to extract for every portfolio. So we started with mutual fund portfolios. The very basic concept is, if you consider to be a safe, let's say a locker, in which some gold coins are kept. So the portfolio value would depend on the number of gold coins currently the locker has, multiplied by the, whereas so at any point of time, putting more gold coin doesn't affect the price of the gold, which is extracted this line. Basically, we took a portfolio unit which has only grown just by being in the market, without discounting, without counting or involving any cash inflows and outflows. So that's how we are able to extract a very definition matches the TWRR returns of any period. So what we have essentially tried to do is we plotted the TWRR returns every day for the entire period of the been able to investment portfolio into opens up a lot of possibilities for us, because now it's like any other stock or any other mutual fund. We can compare it against a benchmark like what we did here, equity 17 at 30. We can compare it against other portfolios. We can even compare it. We have a lot of filters with, let's say, a client is there who has multiple fund managers managing some portion of their wealth. So with this sort of an infrastructure, we can just apply filters and see, okay, who has given maximum growth just by being in the market, discounting the fund they were managing and the cash inflow outflow. So that has been, the primary thing that we have, focused on. So as you can see, this portfolio returns and versus portfolio value. So portfolio value has shows basically how much the portfolio, the amount invested versus the portfolio value. So there wasn't much investment. So like initially it was only 12 lakh rupees, and it all grew just by being in the market, and then it got a bump because of cash inflow. Similarly, if cash was taken out of it, there would be one dip. So this sort of analysis or this sort of representation prohibits us to do to carry out very detailed analysis and other portfolios are benchmark, because every portfolio would have a distinct set of transactions made at different times of different amount of different type. So this is basically, we have consolidated everything into a single graph, and that's where it opens up a lot of possibilities for us. So now what does it essentially means is, again, with this, we also have these metrics: absolute return, CAGR, volatility, sharpe, sortino. Against comparison metrics also we have. against this particular benchmark. So if in theory, we can also see the individual effect of a particular scheme in our portfolio. So in essence, if we see 17% CAGR, 12% annual volatility. So in filters, if I remove a particular scheme, let's say this one, focused equity funds, so we can actually see whether our portfolio's CAGR has increased, volatility remains the same, but CAGR has decreased. So this particular portfolio doesn't add, this particular scheme doesn't add to the volatility of the portfolio, but it adds to the CAGR. But the duration has also changed. So if we have to compare against a similar duration, so let's say after COVID. So after COVID, this portfolio has given, okay, so I have to generate it again. So let's say after COVID, let me just generate it once again. So we have this lots of filters for us to play around with it. So let's say COVID ended at around, that dip ended maybe. Let's start from June. So June 1, 2020 till now, just play again. So June 1, 2020 till now. So it is like 27% CAGR and 10% volatility. And now if I add this particular scheme, I'll see the effect of it. So 20%, 27% and 10. Now with this particular, okay, sorry, I have to do it once again. So 2020 June, let's say first till now. So it's 26% and the volatility has also a bit increased. So actually this is the return, risk and return contribution of this particular scheme in the portfolio for this period of time. So since CAGR has decreased and volatility has increased, it means that this scheme in this particular portfolio throughout this time has not been very successful in its objective. Again, the objectives might differ. Some schemes might have been introduced just to bring more stability into the portfolio. They might have been introduced to again provide a very good upside move. So again, every scheme, and if we have to go with the filters, because in India we have a lot of family members, the familial money is pooled together. So currently it only has this client, but even the family member portfolios can also be discretely selected. We can even select AMC wise. If particular AMC portfolio has been performing against benchmarks, or maybe this AMC portfolio is not at par, we might have to replace, we might have to look for corrections, all those sort of things. So schemes, folios, and broker code. Broker code is very important because some of the times what we've also seen is if a client has multiple brokers, we can apply one broker code. So against a single time period, we can apply filters of other broker codes and actually see what's the returns being generated by all these broker codes. And how a very important aspect of it, how it also gels into our client acquisition thing, is also because all the data that is required to do this sort of analysis comes from two things. Firstly is for a new client, it's a cash upload, simple cash upload that can be done on the platform. It fetches all the transactional, the broker level, folio level data. And secondly is our in-house, market data pipeline that we for this. So in essence, any new portfolio, any prospective portfolio can be just simply, uploaded in the system, and it shows all the detailed analytics can be done in the same. So this is it. There are again, very important ratios that is very important for us. I'll go to the next sections of performance, but I'll just go over other more important aspects also. So second is the asset allocation. Asset allocation normally in stock portfolios, it's not very essential because we already have an idea of the underlying asset that we are holding. When it comes to mutual fund portfolios, however, because we hold mutual funds in different proportions in our portfolio, and these mutual funds in turn invest in various proportions in these underlying securities. And what we've seen is there are only, I would put it, 300 to 400 stocks that fall into this mutual fund universe. Every sort of mutual funds hold these sort of stocks and bonds. So inevitably what might happen is, let's say I have 20 mutual funds. and of different AMCs or different categories. Maybe I've invested in other times. But at the end, it might also happen that like 30%, 40% of my portfolio goes into, let's say, three stocks, because these mutual funds that I hold, they have been investing in these similar stocks, and it so happens that there's a lot of overlap. There's a lot of uh, mutual funds who invest in same stocks. Let's say top three, four stocks, and that's how concentration happens. And that is unknown normally in a mutual fund portfolio, because underlying data, I know we have to scrape, we have to do a lot of rigorous processes to put it in the forefront. So that's what we've tried to do. That's what the asset allocation section is all about. Just to bring in the diversity, the much needed diversification in the mutual fund portfolio, and also trying to get an analysis of what are the actual underlyings that you know are important in my portfolio, who have a lot of my money invested. And again, if I want to check out sectorally, how am I positioned in the market, industrial wise, stock wise, credit rating wise, if I have a debt portfolio. So those things are covered in asset allocation. So very quickly, I'll just jump in. So overlap analysis, again, as it said, two mutual funds. Now, in this case, I mean, these are all same AMC, so it might have an overlap. But if you see, let's say, ICICI Blue Chip, Franklin India Focused Equity. So different AMCs, different categories, in fact, but they have 43% in stock overlap. So if I have to see which are the stocks that these mutual funds have invested in, I can do that as well. I can just click on this, and the entire stock, see ICICI Bank, Larsen & Toubro, all the known culprits. These show up quite a lot in, I guess, most of the mutual funds. So, actually we can check what is the actual amount these schemes have invested in, what is the overlap, and also to help, in decision making, because the core idea of creating the portfolio analytics tool is, to basically enable you to look at a portfolio from very different lenses, figure out the vulnerabilities and the good parts of it, and then help in decision making to either rectify the mistakes or improve the existing ones to reach a new level. So here, what you've also done is, against each fund, you also mentioned these values. So the XIRR return. So let's say if we have to we have, let's say, decided that these two funds, ICICI Prudential Blue Chip and Franklin India, has a lot of overlap. We might think of just putting one instead of these two. Then I'll check what is the rating all about. So here I see similar ratings, so maybe they're still fine. And in current value, I can see 58 lakhs and 10 lakhs. So more money is invested in this. Ratings also remain the same, but XIRR is less in this. It has given me more XIRR, or this one, sorry. So this is where we can do a lot of decision making. This again, decision should not be made solely on this analysis. Everything should combine and overlap, so that the whole decision making is very nuanced in that sense. Again, we can do industry analysis, sectoral overlap. Like we might have a lot of schemes which inevitably have invested a lot in same sectors. So sectors also do rotate. So sectors also pose a risk. So this is what we can also see, like there's 69% in ICICI and Axis. And again, on clicking, we can see those things. Correlation is the simple statistical correlation that we check. If they're highly correlated, this poses a risk because it's not diversified enough. So we highlight all the highest, correlations that are there. Mostly in equity funds, it is usually high, but this is something that we can look at. Also correlations, because they keep changing between short term and long term. We have provided other filters as well to check, in long term, which has been highly correlated, in short term, which has been highly correlated. And again, all these tools to help you in decision making. If you want to check for sectoral funds, these are the filters for all the funds, only for equity funds, and so on and so forth. In concentration, again, I guess this is very important because, as I said, I might have a lot of mutual funds, but at the end, in this case, top three stocks hold 1/5 of my portfolio. Now it's for the fund manager to decide whether, because again, I can have a view on these stocks. Although these are top three, whether these stocks have a good fundamentals or not, I'm safe with it or not, these can be gauged. Also, if I want to check what is the, let's say if these two are all in banking sectors. So let's say if I click on sector, bank sector has around 18%. So does it mean, if banking sector, let's say, goes for a dip or might not be doing that well. So 18% my portfolio and the actual current value of my portfolio is at risk. Although it has a lot of correlation effects with other sectors, but if banking sector suffers, this part of my portfolio is actually suffering, and top three sectors actually 41%. So these are the three sectors that I might be closely watching for this particular portfolio. And on clicking on this, I can actually see the actual contributions made by in this sector, or in this case, if I choose a stock. So in this stock, by these particular funds, and the actual values of my portfolio, like 12,000 rupees have gone into this. So actually, overall, all we can see for every sector, how much is it? So I mean, textile, this portfolio doesn't have anything for textile. It's only 3,000 rupees. But I'm heavily invested in bank, finance, and IT. Similarly for other stocks. Similarly, if I want to check for debt instruments, all these bonds, this is what I'm mostly invested in. All those sorts of things. In distribution, what we have tried to do, I'll just do it for all. So distribution again is very important because traditionally with sort of investment horizon and the client's risk profile, we would want the asset allocation to have a certain mix of equity, debt, or maybe risky and non-risky assets. So in that regards, although I might be buying mutual funds, but they invest in equity and debt assets in other sectors and everything. So this is the underlying holding composition of my entire portfolio. So as you can see, 17% other said. And also if I want to check to the last rupee where the money is invested in, I can just click it forward and see, I mean, all of my equity is in domestic equity. I can click it even further. This is the sectoral allocation of all my the portfolio. And if in a particular sector, I want to see which stocks am I invested in, sorry, the industry. So bank private, bank public, it's only 1% of this is there in bank public. So if bank private, I want to see, I can actually see the stocks where I invested in. So again, the known culprits, all these funds are there. So this is the equity part of it. In debt, again, in a very similar structure, we see the asset classes, certificate deposit, corporate debt, and each one we can actually see the rating, whether I am always invested in highest of rating bonds or not. And in that, actually, which bond has how much allocation of my actual portfolio and the current value of my portfolio is invested in these bonds. So till last level, we can actually check where the money is going. Again, you can also identify if, let's say, I figure out, like if I have to show an anecdote, a year back, suddenly, bad news came about Adani. At that time, Adani took a dip. So I could actually see from this tool, okay, this particular portfolio has this much in Adani. So that's a very good foresight to have. How much of our actual portfolio's value is at risk because of this news? Because these queries can come in at any point of time. And eventually, when mutual funds sort of diverge from this stock, the asset allocation and the concentration also, veered away from Adani. But then again, positions were made. So this sort of a very detailed analysis can be done through this asset allocation tool. Then comes the risk measures. Risk measures is, I would say, very important because every portfolio should have a very healthy mix of the high flyers, the anchors, and the middle portion. So high flyers would be the risky assets. They would have a lot of risk, maybe small cap, flexi cap, those funds. We want them to take more risk but give us better returns. Similarly, for debt funds, we just want to give them to give us some stability, some anchor to our portfolio, and then the hybrid funds should in a way lie in the middle. So if you see in this particular portfolio, the portfolio is placed at the middle with this annualized return and annualized volatility, all statistically calculated. And in this respect, if we see the highest is this one, this particular fund, Plankton India Focused Equity, it has given a good return, but it has taken more risk also. But this is also the fund we had analyzed in scheme overlap. So, I mean, this fund is sort of doing the job. Whereas if I go to this fund, again, it's a savings fund, category debt, it has given me volatility, very less volatility and good enough return, what it is supposed to give. So rack. And this also it is giving a good return, annualized, but less volatility. To aim this further, so to further probe into it, what we also provided is these very specialized filters, wherein you can actually see. So I just expand this. So we can filter schemes based on their XIRR their quartile of XIRR. So basically, top quartile XIRR schemes would be the schemes in my portfolio which has given me the highest XIRRs. And then we have current value. So this particular filter would have all the top schemes by current value in my portfolio. So let's say if I choose to see whether the scheme that I have heavily invested in, is it giving me good XIRR? So then if I apply this filter, only those schemes will be highlighted. So we can actually figure out which are these schemes. Let's say if I want to check, I have given it a lot of money, but XIRR wise, let's say if it is bottom quartile, I just want to find this fund. Okay, where does it lie? How much additional risk is it taking to my portfolio? Is there something we can do about it? So all those sorts of analysis or decisions can be made, or at least those sorts of impressions can be generated. So expected again is a very statistical figure. Historical is what we generate from the portfolio NAV chart, those time series. Expected, it follows some portfolio theory aspects of these risky assets in a particular proportion, how my portfolio is expected to work in the next year. So this is where it is. The portfolio still remains in the middle section, but the absolute values change and the respective position of these schemes also change. So this sort of gives an expectations. Okay, this particular portfolio with these many schemes, these risky schemes, each scheme having a different risk return characteristics in this particular proportion will affect this particular portfolio, and expected risk reward would be this much. Similarly, drawdown again, it's all historical. Drawdown is very important because now that we have, because most of the time what happens is during market drawdowns. So when markets are down, active decisions are made to provide a cushion towards these falling drawdowns. And when again, on the contrary, when markets are gearing up for a bull run, we want our portfolio to capture the momentum as much as possible. So this is where the drawdowns come in. This shows historically how the drawdowns were managed in this particular portfolio. And the way we have counted these drawdowns also is which are more than 10 days and have not more than 10%. So those we counter as drawdowns. And these are some statistics on those, how many days it took to recover, what was the loss, what are the start NAV and NAV, those sort of things. Key periods, again, it's sort of a retrospective. We are looking back at the portfolio on how it performs on very specific period in the mutual fund industry where geopolitical or any structural change happened, which had a turbulent effect on the market, and how our portfolio compared to this given benchmark on that particular period. Similarly, rolling risk is an account of how the risk has been managed historically in this particular portfolio. Rolling analysis, as the name suggests, we look at how the portfolio has. So basically, we are aiming for consistency when we do rolling analysis, and rolling volatility gives us a picture of how the volatility of the portfolio has been kept under control. So if you see against this benchmark, benchmark has given high volatility in these periods than the portfolio, whereas in this period, the portfolio has given higher volatility. But in statistics, we can actually see the average of portfolio is around 11% and 12%. So historically, we have given year on year, because it's a 1 year rolling, or year on year, we have given on an average 11 point or 12% of volatility, very closely similar to this particular benchmark. And then again, scheme details, we can actually see, because investors most of the time, they don't have ready reference of all the data in the scheme that they have invested in. So again, every mutual fund portfolio, the schemes in the portfolio has been very neatly categorized into these very sections, and each scheme can be again further clicked to see a very detailed fact sheet. Sorry, very detailed fact sheet. It has again all the overview performance portfolio tools. So if at any point of time, if you are sitting with your clients or the client wants to explore themselves, they can actually see and discover all these aspects about their portfolio. So now, very important question that so far I have avoided is the question of benchmark. See, every portfolio or every sort of investment analysis should be done comparing it with a benchmark. So how did this portfolio know that equity 70, debt 30 is the correct benchmark? So that we automatically triggered. So what we did is asset allocation, because it has this sort of an asset allocation. So we can actually in the setting section, you can actually set which particular benchmarks do I want to set for this sort of asset allocations. If I don't want to set any benchmark, that also we can do. And when it comes to benchmark, we have a whole list of benchmarks. Equity benchmark, all the publicly available benchmarks can be added. Equity debt, we can even create custom benchmark. So this is what we have tried to do. We can create a benchmark by putting multiple benchmarks in different proportions. And for this particular client, we can disable the benchmark, use the default benchmark. So this gives us a lot of breathing space, a lot of I would put it, lot of wiggle room when it comes to different clients. Some clients we just want to compare against the stock benchmarks that we have provided. Otherwise, for very detailed HNI clients, we might have need to create a particular benchmark to compare it against, and those sort of things. Because some people might want to see how much they've been missing out. So I might compare it against a small cap 250. Otherwise, if they want to see actually how their asset allocation with this asset allocation, how they should have performed, we can compare it against these particular benchmarks. So lastly, so the scheme rating, I'll very briefly jump into it because I think we are out of time mostly. So ratings, what we've done is we've come up with our own rating methodology. It uses short-term and long-term, risk and return perspectives of each individual fund in its category. So we compare it against the category average, we compare it against the category benchmark. We have a lot of quantitative, it's purely quantitative. We don't do it anything qualitatively. Every quarter we go and this algorithm is run to generate ratings. It also takes into account the fund management style, the assets that it holds, any other credit rating sort of analysis if it's done, that's also taken in. So that's rating. And for performance also, I'll just very briefly go through. This is the discrete returns year on year. We can do it quarterly, monthly. This gives us a picture of on year on year how the portfolio has been performed. Rolling analysis, as the name suggests, we do rolling analysis on the portfolio, and primarily, on an average, how much it has given year on year. Because some years it might give more, some years less, but on an average, consistency. This basically shows consistency and volatility also. And then distribution. Distribution, in a way, it sheds light on the probabilistic aspect of a portfolio, because portfolios are made of risky assets. Risky assets are not deterministic in nature, but probabilistic in nature. So in that sense, you can see a very beautiful bell curve of the quarterly returns generated by this portfolio against this benchmark, and in which, we can see what's the negative probability, a probability that this portfolio over a quarter might give a negative return, the confidence interval, 95% probability of, the returns lying in this particular range. All these things can be figured out. And also, so this basically constitutes our portfolio analytics tool. The overview page is just a brief consolidation of all of these individual elements, in terms of performance, risk, return, and scheme details. And everything can be downloaded in a very overview report and a detailed report. Detailed report comes, it's a 9-10 pager, and every aspect is, eliminated in that. Also, FAQs are present. We're also coming up with insights, because currently the way it is, the tool, it's descriptive in nature. Like we have to go looking for insights out of these charts, out of these analysis. What we've also done is we've identified a laundry list of insights that I want to get out of these charts. So, and we have codified everything. And so let's say in this chart, if I want to see the portfolio is currently in its all-time high, let's say. So that can be very briefly mentioned in the side panel. So this is what also we have tried to build around this tool, and it's going to be releasing very soon. We are just working on that. So yeah, that's mostly it.